Let me now bring on board Chetan Aya, Managing Director, Morgan Stanley. Chetan, morning. Thank you for joining us. Chetan, what do you make of the quality of budget assumptions for the year FY13? Fiscal deficit target at 5.1%, GDP growth at 7.6%, and government borrowing at about 4.3 lakh crore.
Yeah, so firstly on fiscal deficit, we are expecting the deficit to be at 5.6 versus the budget number of 5.1, primarily because we think that the expenditure is slightly understated because of higher subsidy burden potentially likely. And at the same time, we think that on the revenue side also there is some overestimation. And this is of course because we have a GDP growth estimate of 7% versus the government's estimate of 7.6. And because of higher deficit, the borrowing estimates that we have is 4.8 trillion on a net basis, and on a gross basis it will be about 6 trillion.
Chetan, hi, morning. The ratio of private investment to GDP has been declining in the recent times. Do you think the finance minister this time has done enough to reverse this trend in the recent budget? And what is your outlook on the revival in private investment as well as industrial activity?
Well, nothing much has been done in the budget. What we've seen is that the higher tax burden should actually be a negative incentive. In fact, if you go past Dig's last speech of the finance minister, he himself mentioned that he is not hiking excise and services because he thinks it will be a negative sentiment for investment. But unfortunately, he's done that this time. So at the margin, actually, it's not really worked in terms of attracting more private investment. And therefore, we are forecasting private investment to go down from 11.7% of GDP in March 12 to 11% in March 13.
Chetan, I just want to get you in on the government's target on GDP. A GDP growth of 7.6% for FY13. Is that being too optimistic?
Well, I wouldn't call it too optimistic, but it's definitely optimistic. We are at 7%, as I mentioned earlier. And the key reason is that I think the investment line, which is a large part of the GDP, we still don't see enough triggers for that to go up in March 13. And at the same time, the tax increases, we eventually will have to see fuel price increases will also affect the consumption trend. So net-net, I think the two of the big domestic demand drivers are unlikely to be pretty strong in the next financial year.
Chetan, there are two big assumptions. One assumption for the year FY13 is the disinvestment target of 30,000 crore, and the other one is the auction of 2G spectrum, and government is targeting to get something like 50,000 crore from that. Now, both these assumptions are a function of market condition, and the disinvestment target clearly backfire for this year. Do you think the government will struggle to meet the disinvestment and 2G auction targets for next year?
Well, I think the disinvestment is tough to say. I mean, it depends upon how market conditions go. But I think even with the current kind of market conditions, that target doesn't look optimistic. It seems achievable. But on the telecom front, our telecom sector analyst thinks that they are slightly optimistic on the auctions number. And the detailed math is not completely available, but we guess that they have probably not built in the charges they have to pay for cancellation of 2G licenses. So whichever way you take it, the combined number on telecom license fees or telecom fees appears to be slightly optimistic. The divestment number seems to be more achievable.
So Chetan, I just want to get back to the point that you were making about the GDP. If 7.6% for FY13 is optimistic, what is it that you're pricing in as your target for FY13, and what do you think are going to be the growth drivers which are going to lead us to that figure?
As I mentioned, it is going to be 7%, and the drivers are essentially, we're saying that it will remain the same conditions that we have right now. For March 12. March 12, our number is at 6.8%. So we are seeing no major increase. And effectively, we're going to have challenges in driving this line up from consumption side as well as from the investment side. We are also expecting the exports numbers to be moderate, not very strong, like what we had until recently. So, yeah, all in all the drivers don't seem to be in a position to take this number up meaningfully. And what you have to still watch is what is happening to oil. That poses actually downside risk to our numbers if oil continues to edge like this, up, and it's on Friday closing at $126 on Brent. So that's something which we have to watch closely as another number to see whether this 7% number is also realizable or not.
Right. So Chetan, that leads me to my next question. What about the central bank action? When do you think the RBI would have room to cut repo rates because of the rising inflationary scenario, and oil is still continues to be on the boil? We don't know where it's going to stop.
Yeah, so oil is the key. So right now we are saying there is a 50-50 chance they do it in April. And the predicament for RBI will be on what happens to global commodity prices between now and when they meet next. We have seen oil going up. We have started to see some of the other commodities also gradually catching up. That will make it a difficult condition for RBI to cut interest rates in April as well. So touch and go, and let's hope oil goes down.
Chetan, the budget also mentions a possible GST, rollout timeline. Are you a bit surprised with that? The central government and the state governments are clearly not in sync with each other. The political situation for UPA is deteriorating on a daily basis. So given the kind of political backdrop we are in, do you think it will be next to impossible for the central government to roll out GST?
Well, the answer needs a political analyst rather than an economist. So at this point of time, we are not building in for that to materialize in the current financial year. We are building in for it to happen, if at all, from April 13 onwards.
What about the assumptions of planned and non-planned expenditure? Do you think they could backfire at a time when Indian economy is still exposed to global risks?
Yeah, I think that's a very important question. I don't think that the market is really understanding this issue. So the budget is talking about a 13% total expenditure growth. We think it will probably be around 14.5–15% growth, which, frankly speaking, is not something that the economy can take right now. What we are continually doing is trying to support GDP growth through unproductive expenditure line, which is the government spending, which is 15% is quite high in the context that we are in right now, and we're talking about fiscal consolidation. And what the government has tried to do is to give some credibility to their numbers by increasing the tax burden, which is a negative incentive for the private corporate sector for investment. So from a macro perspective, we still continue to boost growth with a less productive line item, and we're not able to kickstart the private investment, which is the productive line item. And that is going to be a factor which will affect the inflation dynamics, it will affect the current account balance, it will affect the interbank liquidity. I don't think the budget really helps to address these issues in a meaningful manner.
So by and large, would you say that the tone of the budget was more investment oriented, it was not consumption oriented?
No, I wouldn't say so. I think it was neutral from investment perspective. There were some micro incentives laid down to get infrastructure sector going. But at the same time, I think the overwhelming negative there was the increase in tax burden for the corporate sector or the consumer, whichever it is that you want to take. As I said, the finance minister himself had mentioned in last year's budget speech, increasing tax burden is an overwhelming negative for investment sentiment. So I think nothing done for investment, a slight negative for consumer because of increase in tax burden. And probably there is an implication that there will be increase in fuel prices. That's what is implied by the lower subsidy burden. So if that is executed, that will be other negative for the consumer. So negative for consumer, nothing much for the investment line.
So Chetan, looking at the domestic as well as external factors, do you think India will continue to see inflow of liquidity?
I think it is entirely global factor driven. I think when people put money into emerging markets, it comes to India too. And a lot of other emerging markets also have problems like India. So India is not unique to have some of these macro issues that it is facing. But I think the question is whether you really get that full intensity of animal spirits back in the global markets. And our team is not exactly banking on that because we are still conservative on our forecast for Europe and US. We're expecting Europe to grow at minus 0.3% and US to grow only at 2.2%. So that is not exactly a robust environment for global economy. So I would not bank on too much support from capital inflows. It will probably continue to be like what we are seeing in the last 1 or 2 months.
Chetan, since most of the basic demand indicators are showing signs of turning around, whether it is cement demand or steel demand, do you think Finance Minister will be able to overshoot his revenue estimates? Because the joker in the pack, A, is crude and B is interest rates. So if interest rates go down and demand is coming back, you never know, he could also overshoot his revenue projections.
Well, no, not really. Even if you take away the increase in tax rate effect on excise and services, the underlying number is still assuming a fairly decent growth environment, and tax revenue growth excluding the rate effect is still showing acceleration versus March 12 financial year. And March 12 financial year, as you know, we had lower real activity, but the nominal activity was strong because of inflation. So the tax revenues were pretty strong in the first 3 quarters of the financial year. And when you compare that with the coming financial year, unless you are saying that inflation is going to be again a big problem, and that's what probably will help government on tax revenue, I really don't think that there is a risk for upshoot of tax revenue numbers here.
Chetan, what's your outlook on rupee? I mean, we've seen a fair amount of volatility and depreciation now. Where do you see the rupee headed in, say, the next 1 or 2 months?
I think the rupee is going to be volatile with the downside bias, because we run a fairly high current account deficit, as you would have read in the finance minister's statements as well as the economic survey. March 12 current account deficit is likely to be now 3.6% of GDP, which is the highest in history. So I think with that kind of current account deficit, we will be very much exposed to what happens to capital flows. And as I mentioned earlier, the global environment hasn't yet fully settled. So I would say the fundamentals are still pretty weak as far as the balance of payments are concerned. On a real effective exchange rate basis, the rupee looks fairly valued though. But I guess the problem right now will be the flows management in the near term.
Chetan, let's wrap it up with one final comment on fertilizer subsidies. We always discuss oil subsidies, but this year or for next year, the fertilizer subsidy assumption is also down by about 10,000 crore. Do you think that's a realistic number?
No, I think there is a slight bit of, so when I mentioned in our numbers on expenditure growth, I mentioned overall subsidies. I think there is a bigger problem in oil subsidy and there is a smaller problem, but yet there seems to be a small underestimation in fertilizer subsidy as well. And mind you, on food subsidy, there is an assumption that we are making right now in that expenditure growth number that there will be no big impact of Food Security Act in the coming financial year, and that it will get pushed more to F14. If that gets implemented and you have an additional burden on Food Security Act, that's the other upside risk to expenditure.